Welcome, everybody. My name is David Bush from Overflow Works Marketing, and I'm excited to be your moderator today for this exciting webinar on FHA Streamline and reverse mortgage direct mail strategies and how to recruit loan officers who can close leads. And buckle up for the next hour and 15 minutes because we're going to provide you with an action-packed opportunity to take in a lot of great information. This particular webinar is going to be in 3 different parts or sessions. If you want to stick around for all 3 sessions, you're more than welcome to do so. This is going to be an awesome opportunity for you to pick up a bunch of opportunity and a bunch of information on how to improve your results with your mortgage business. The first session, we're going to focus on marketing strategies to fund an additional $5 million in FHA or VA loans for $5,900. And if you don't believe that to be true, just stick around and listen to how others have done so. And then we'll go into the second session, which is how to fund additional reverse mortgages for over $3,900 in marketing costs. And then we'll lead into the final bonus session, which is how to recruit loan officers who can close leads. So we're going to spend about 25 minutes in each individual session. We're going to go through it fairly quickly. It's going to be interactive. We're going to ask for feedback and for questions from the participants, and we're going to hopefully get to all those questions as time goes on. So stay tuned, and we'll get started here in just a moment. But before we do, I want to introduce one of my panelists today. Jeff Bush is the president of Overflow Works Marketing. Jeff has got over 20 years of direct marketing experience. He's done over 1 billion direct mail pieces for the mortgage industry. He also owned a mortgage banking company that closed over 5,000 loans from 2000 to 2007, leveraging direct mail as its primary lead generation tactic. So Jeff is considered a nationwide expert in the area of direct response marketing and in mortgage marketing. So it's a pleasure to welcome Jeff Bush to the webinar today. Jeff, are you there?
Yeah, thanks for having me, Dave. Appreciate it.
Well, let's just jump right in and talk a little bit about your background and your company, Overflow Works, before we get into today's session. But talk a little bit more about the experience and success that you had in the mortgage industry and the direct mail industry and how you've parlayed the two of them together in creating your marketing company.
Well, I've been selling direct mail advertising for, as it says here, about 20 years. Ever since I was, like 20 years old, I got into direct mail advertising, and it sold a ton of direct mail to mortgage companies and car dealerships were kind of the 2 niches that I've been in all this time. So I spent a long time in that business, kind of mastering direct mail lists and phone lists and writing copy and writing successful letters. But our direct mail company that I was a part of actually sold, and I had to sign a non-compete and get out of the business for 3 years. So at that time, I decided I would go start a mortgage company because a lot of my mortgage clients were making a lot of money and it seemed like a fun business. So I started a mortgage company in 2000 and ran it for 7 years and kind of built the whole business around my knowledge of making the phones ring. I really didn't know how to do loans and didn't understand the business, but I knew if I could make the phone ring with all these qualified leads, eventually I'd figure the rest of it out, which I did. And, we had a $20 million warehouse line, and we owned an escrow company and a mortgage company funding loans in our name. So it got pretty big pretty fast. And then when the mortgage business turned in late 2007, we weren't really prepared for it. So we shut the company down, and I kind of went back into direct mail. So that's my background as far as direct mail marketing in the mortgage business.
And for the last couple of years, you've been specializing in targeting mortgage prospective candidates and really working back in that mortgage industry. Talk about the success that you've had and what particular niches have really proven to be the most successful over the last few years.
Well, I'll tell you, one of the questions that always comes out is, Jeff, if you were successful in the mortgage business, why aren't you back in it? I mean, it's pretty hot right now. And my answer to that is, if I would have known that we were going to be able to fund, 200% LTV HARP loans, in April of 2012 when that came out, and if I would have known rates were going to be, 3%, and FHA Streamlines were going to come back, and there'd be thousands of FHA and VA Streamline loans to refinance, I would have kept my mortgage company open. I wouldn't have shut it down in 2007. I just looked at the landscape of the business late 2007 and thought, my God, it's going to take 10 years for equity to come back. There's no loan programs. All these lenders are going out of business. So, magically, April of this last year, when all these government stimulus, programs started coming out, HARP and FHA and VA and rates were low, we've just had a huge amount of business come in here from mortgage companies that are direct mail marketing these people, making their phones ring and closing loans. I mean, I've watched companies that started in April of last year getting back into the business with one loan officer funding 5 loans a month, and now they've got 30 loan officers, and they're doing 150 loans a month, and primarily from leads and direct mail and combination of some internet leads, telemarketing. So the business is good. I've designed a lot of direct mail programs around these borrowers that qualify for all these programs: Fannie, Freddie for HARP, FHA, VA, FHA loans prior to May of '09, for the MI reduction. So we've kind of mastered all the data and the creative letters, and just getting a great response, and watched a lot of mortgage companies grow big over the last 12 months.
That's great. Well, I have a poll up right now, and I'm going to close that in the next 5 seconds. So if everybody can go ahead and cast their vote, just kind of curious of who's already doing marketing, even at the very lowest level, and then who's out there that's doing it a little bit more aggressively. And if you're not doing any marketing, that's okay too. This is your opportunity to learn from one of the top marketing experts in the country, and you can go ahead and click on your vote. That'd be great. We'll go ahead and close that poll up in the next few seconds. Go ahead and cast your vote. And Jeff, as I lead into our first topic, which is FHA marketing, I want you to just kind of give an overview of, what that FHA market looks like right now with some of your past clients, and just, what are the hot things that you're seeing with FHA Streamline marketing?
Well, the FHA program being that, it came out, April, I think, of this last year, so it's almost been a year since it came out. So obviously the guys that got in early and started mailing all these pre-May of '09 FHA loans that qualify for the MI reduction, I mean, some of these guys were spending $5,000 on a mailer with me, funding 30 loans, making, 100, 150 grand. So the people that got in early got these huge response rates and kind of, captured what I call, the low-hanging fruit. But even though response rates have come down, they're not 1.5%, 2% response anymore. Now they're down to like 0.5% to 1%. We still have a lot of mortgage companies mailing the pre-May of '09 loans. It's amazing those people haven't refinanced yet. They're still paying 5, 6%, interest rate, and they can lower their MI and save a lot of money. So we're mailing a lot of pre-May of '09 FHA loans. We're mailing VA loans that are paying 4.875 rates and higher. We're even mailing some of the newer FHA loans and taking them out of their FHA loan, putting them in conventional. The market's starting to rebound. We've seen 10% appreciation here in Southern California in the last 6 months. So amazingly, a lot of these FHA borrowers that bought a couple years ago are starting to get to an equity position where we can take them out of their FHA loan, put them in a conventional, save them a lot of money on the mortgage insurance and lowering their rate. So that's the basis of this program, is it's going after these FHA loans. It's still been real profitable. Not quite as much as it was when it first came out. That tends to be the way it works. It gets saturated and response rates go down. But, these guys are still spending $5,000 on a mailer, making, $20,000 to $50,000 in profit. So.
Well, we have a screen up right now that just kind of shows a best case versus a worst case scenario, and we're going to get to the comparisons between the Streamline refinances and the non-Streamline. Talk a little bit more about expectations. Does a typical mortgage company, drop 10,000 mailers all at once? Do they do anything less than that? What's been your best practices?
Well, there's a big price break on 10,000 mailers, so we'd suggest somebody come in and commit to 10,000 letters. You can do them in 2 drops of 5,000 if you want to split, and if you don't have enough loan officers to take calls, that would come in over a 1 to 2 week period. So what we're showing on the screen here is kind of a best case scenario on an FHA mailer and a worst case scenario. Mail 10,000 letters. I'm still getting in some states, 150 inbound phone calls, a 1.5% response on 10,000 letters. And if you have good loan officers that are good at closing these incoming calls, you can close 30 loans and make, 20 times return on your investment. If you're in California and there's, 1,000 mortgage companies and they're all mailing and calling these FHA people, you're probably not going to get 150 calls. You might be, 0.5% only get 50 calls and close, 5 or 10 loans, but it's still a great ROI if you spend $5,000, even if you only make 20 grand back. You could do that every week, every month, and overall for the year, make a lot of money on generating these calls.
We're going to get into talking a little bit more about the data sets that you use and the specific filters that gets you the best response. But until we get done with this poll, I want to ask you, what is the typical, client of yours? How many FHA Streamlines are they closing with you, or before they get together with you? Are they typically, high volume shops? Are they people that are doing 5 to 10 a month? What's been the common number around your current client load?
Well, I mean, it's extremes. I have one client in Orange County, California, that spent $200,000 last month on direct mail and funded 180 FHA loans. So that would probably be on the largest scale. And then I've got little mortgage brokers that are 1 or 2 man shops or loan officers by themselves that are, closing 3 or 4 FHA loans a month, and they're, they call me and say, hey, here's $3,500. See if you can get me another 5 or 10 funded loans a month. So, I mean, it varies depending on the client and their marketing budget and how many loan officers they have to take calls. But anywhere from 3 to 180 FHA funded loans every month.
Great. So a lot of capacity out there. And I'm going to close up the poll. If you haven't voted on the poll, we're just kind of curious of how many FHA Streamlines that you're currently closing per month. Go ahead and cast your vote. And while you're doing that, Jeff, why don't you go ahead and talk a little bit more about the data? We got a lot of questions coming in. And for those of you who would like to submit a question, use the GoToWebinar control panel. All the participants' phone lines are muted, and we're not going to be calling on anybody with their hand raised. So submit your question or concern to GoToWebinar control panel, and I'll address those to Jeff as time allows. But Jeff, talk to us a little bit more about data.
Well, in the mortgage business, there's only 2 places to get data. There's public records, which is mainly secured by First American and Fidelity, the big title companies. First American owns CoreLogic, or used to own CoreLogic, and those are the public record databases. That's one option. The second option is the credit bureau, where we go into the credit bureau and extract names that fit your criteria with loan amounts, loan open dates, credit scores. So only 2 different places to get data. About 8% of my clients right now are just marketing public record data. They don't like all the compliance that's involved with mailing the credit data, and it's more expensive. Big disclaimers on the mail piece. So 80% of my clients are still using public record data and having a lot of success with it. We take those public records from some big files like First American and Fidelity, and we clean them up. We run them through national change of address. We take the people that are notice of default, basically foreclosures, off the list. We make sure they haven't recorded it against the property, because FHA marketing is so critical to use the pre-May of 09 FHA loan to refinance, 6 months ago. We don't want them on our list anymore. So we refinance, there's a new loan date, we take them off our list. So, those are the 2 different lists that are available. We can target by loan amount, loan date. With the FHA marketing, it's really important to find a way to get the reverse mortgage prospects off your list. Reverse mortgages are funded and recorded as FHA loans, and sometimes it's hard to tell the difference of a FHA Streamline and a reverse mortgage loan. So we spend some time to clean your list so you're not getting calls from seniors curious about Streamline refining their reverse mortgage loan. So we've just learned a lot of things about the data through the years, to where we got it pretty fine-tuned to get a good amount of calls and a good closing ratio, good calls. So,
Jeff, I'm showing the screen now on the FHA credit data. Talk a little bit more about the current number of qualified leads that are out there, and how recent is this information?
Well, the public records are updated on average about every 30 days. It kind of depends on what county you're in. Some counties are a little longer. Some are, updated weekly, some monthly. The credit bureau data, if we go pull credit, we're going to go right into the credit bureau and pull a list, current FICO score, current loan amount, current, most recent loan recording date. So these are some of the numbers of the pre-May of 09 FHA loans that are still out there that haven't refinanced yet, with a 640 and above credit score, 150,000 higher loan amount. And again, all these loans were open prior to May of 09, so we know that they haven't refinanced yet. Once they refinance, it updates the credit bureau on a new loan date, new loan amount, and the public records, new loan recording against the property.
Now, you've talked about saturation in the FHA market, FHA Streamline market, and you've provided us with a comparison here of an FHA national count. Now, is this public records or is this credit data that we're showing on the screen, Jeff?
This particular list that you're looking at is public records. So just to give you an idea, in California, I don't know if you can read this clearly, but there's 39,000 FHA loans prior to May of 2009, 150 and above loan amounts that haven't refinanced yet. There's still 39,000 of them. This count, by the way, like 9 months ago, was like 200,000. No, 160,000 people have refied in the last 9 months their FHA. Out of the 39,000 mailing addresses we have, only 3,400 are available to legally call that aren't on the do not call list. So we provide some phone numbers on the list so people can make phone calls. But if you scroll over to the right, the other column shows 134,000 FHA loans after May of 2009. They don't qualify for the MI refund, but what we found is some of these people are paying interest rates over 6%, so you can still refinance them and get that net tangible benefit. Some of these people have equity now, and you can take them out of their FHA loan into conventional and save them on eliminate their MI insurance altogether. And again, so those are just some numbers by state that we pull, and we update these counts every month. 40,000 old ones in California, 134,000.
Well, I've got a couple of questions that are coming in, Jeff, in terms of which area to focus on. We're talking about FHA streamlines and even going outside of the streamline market for FHA marketing. But if you were to spend money on marketing, would you go FHA streamline, FHA non-streamline, or would you go HARP?
That's a great question, and a lot of clients ask me that, and I tell them kind of our average response rates on HARP, FHA, VA, reverse mortgage, and I just kind of try to paint a picture of, we don't have the crystal ball to tell you exactly what you're going to get. We've got a pretty good idea, but what I like doing is, hey, why don't you try 5,000 FHA, 5,000 VA, 5,000 reverse, 5,000 HARP. I'm even doing some conventional refi mailers that are working pretty well. Let's divide this thing up into 4 different campaigns, 4 different lists. I'll give you 4 toll-free numbers so we can track each campaign separately. And let's let you be the judge. Let's calculate how many calls you get on each campaign, but more importantly, how many loans did you close and how much money did you make on these loans, per campaign. And then once you've tested our 4 best performing lists, we can come back and maximize that one in the future and then put all of our money into one campaign, or maybe 2 out of 4. I've got a lot of clients mailing multiple campaigns right now. And it's funny, different responses around the country. That's funny, I was just going to ask you if you had the highlighting tool available, because if you look at this FHA rate chart that we're showing, this is right from HUD, and it's pretty valuable information. What was the average FHA interest rate per month, per year? How many loans were done for the year? So you can see everybody's targeting May of 2009 and older. So if I look on this chart, I hope May is the 5th month. I don't know, the fiscal year with HUD is kind of confusing. But, interest rates May of 2009 looks like 5.38%. And we've been mailing all the older ones. So they're all paying 5s and 6s, interest rates and qualify for that MI reduction. But look at, for example, October, November, December of 2009. I don't know if you can highlight month 10, 11, and 12 in 2009. FHA interest rates shot up over 6%. So we've been doing mailings just to those 3 months, October, November, December of 2009. They don't qualify for the MI reduction, but there's thousands of these loans out there paying over 6% that there's still a benefit to refinance. So what we do at Overflow Works is try to find kind of some hidden pockets of data that aren't saturated to get you a good response, to get you a good closing ratio. I mean, we're not 100% perfect on all this stuff, but, we know more than most about this data and which, people are going to respond and be able to close. So anyways, that last quarter of 2009 rates were high, good months to target that aren't as saturated as those older FHA loans.
Jeff, we've got about 5 minutes left in terms of the FHA Streamline marketing session of our 3-part webinar series. I know that there's, an equation or a formula that goes into making a direct mail campaign work, and maybe you could just walk through what's weighted the most in terms of list quality, marketing piece and then the offer as we kind of scroll through these different letter options that you've created custom for clients?
Sure. So you're going to show some of the letters here?
Yeah, the first one's the handwritten letter, but talk a little bit more about the balance between those three variables and how you kind of weighted those out to create the best kind of campaign.
Well, I used to mail like 300,000 pieces of mail a month, and my standard letter was just a window envelope, and I had my costs down to, 40, 45 cents a piece, mailing hundreds of thousands of letters every month. But once the list got saturated, I would go in and start changing the mail piece. Like this sample is hand addressed, 46-cent stamp, handwritten letter. Once these are saturated, you've got to do a mail piece that's more unique, and it's going to get attention and get open. When these people start getting 2, 3, 4 letters a week at their house to refinance their pay loan, you got to get creative to make the phones ring. So this is a handwritten letter. This letter costs $2 a piece versus 40 or 50 cents. But at the end of the day, if I get 2 or 3% response instead of a 0.5% response, I'm better on the $2 letter. Showing up on the screen now a snap pack that has the little tear-off sides to it. This is a mailer where we go in and show them how much money they can save, not just on their interest rate, but in their mortgage insurance. And we have calculations built in here on their loan balance, what their payment could be, how much they're going to save on MI. This letter says, John, that's a monthly savings of $609 and a yearly savings of $7,500. So we use their specific loan amount, and we calculate payments and savings per month, savings per year. You've got to show a strong offer on your letter. Data is definitely most critical on any direct mail campaign, but if you don't have a strong offer, I don't care how good your data is, it's not going to work. So good data and a really good offer to get their attention. This mailer you're showing is a credit score mailer with all the credit disclaimers on there. We mailed it out to people with 640 and above credit scores. I'm sorry, this particular client said, Jeff, everyone's going after 640 and above credit scores. I've got a lender that'll do no FICO score requirement. I want to mail people between 500 score and 640 to help all the people no one else is helping. We mailed 5,000 letters. She got like 70 incoming phone calls, closed a bunch of loans. That's kind of a little niche-y mailer. Low credit scores, FHA instead of high. Pre-approved offer, front and back of the letter. So another sample.
Jeff, just a couple questions from participants. Chris has got a question in terms of how many clients that you sell the same exact data to, and in terms of that data, how are you different than any other mail house that can go in there and grab public record data and sell it?
Well, you can go get your own list for free from your title rep probably, and then you could go try to mail that list. So what I found is a lot of the addresses are bad. A lot of people already refinanced. The loan amount's not accurate. So we put a lot of extra time into our data to clean up the public record data that's out there. So our lists are better than most. If we have a client mailing 5,000 FHA letters in Rhode Island and there's only 5,000 FHA borrowers in Rhode Island, we're not going to go sell another client that same data. So we give you an exclusive on the data for at least 60 days to make sure, we want long-term business clients ordering every month, so we're not going to go hurt your campaign by selling to someone else, the same month, with the same letter. I mean, it just kind of cut our throats.
How do you use in terms of color and when to upscale and go, color or go to a handwritten? Do you have a certain methodology, Jeff, that you use before you make that extra investment in the marketing piece?
Well, for 10,000 letters, color costs $1,200 more, to run a letter in color. And what we found is it doesn't increase the response at all. So 99% of all my letters are black and white. This particular client is on the Inc. 500 list, and they're proud of it. They're in Missouri. They're a growing mortgage company, so they wanted the Inc. 500 in color and their logo in color and some red. And, the letter turned out nice. It looks a lot nicer, but it doesn't work any better than a black and white letter. But some companies are more, they want to not only get a bunch of calls, they kind of want to brand their name and their logo, especially if they're mailing their local town. We might even print a color logo on the outside envelope and come clean with branding the company's name.
Sure. Well, we're just getting to the end of this FHA Streamline marketing session, Jeff. Talk about next steps and what somebody would need to do if they'd like to get more customize answers to their personal marketing questions, or just to take advantage of your marketing services?
Well, the first step would really be to call or email and tell us what states you're licensed in. Let's see how much FHA, VA, HARP, whatever reverse mortgage data, whatever you're interested in marketing. Let's run some numbers and find out what's still available prior to Mambo 9, but let's look at some of these other pockets of data that we're having great response on. Let me show you 3 or 4 FHA marketing campaigns that got huge response rate, show you some letters, show you some data, show you the pricing, run through what we think the response and closed loans ROI is going to be, get some proposals in front of you, and basically we'll put all that in front of you, for free to look at it all and see if you want to move forward with testing a mailer. Our minimum order is $3,500. Our average orders are, 10,000 mailers for $5,900. So $3,500 might be a stretch for some clients, but the first loan you fund, you make all your money back, and everything after that's, profit. And average clients are funding 5 to 10 loans on 5,000 letters, and 10 to 30 loans on 10,000 letters. So we'll run through the numbers, email you, maybe get on a conference call, really, spend some time with us. Spend 30 or 40 minutes with us on the phone. Pick our brain. Let us show you what's working for all these other clients. I've only got about 50 clients nationwide doing this right now, so there's plenty of data out there. And I think we can keep duplicating this success for more clients.
Great. Well, that concludes our first session on how to increase your FHA Streamline marketing opportunities and generate more FHA Streamline loans. Now we're going to transition, Jeff, to the how to fund 4 additional reverse mortgages for only $3,900 in marketing. So for those of you that want to stick around, please stick around for the webinar. And if you're just joining us, we're talking with Jeff Bush, the president of Overflow Works Marketing. He's got over 20 years direct marketing experience, and he's mailed over a billion. I was going to say a jillion, but that doesn't make sense. It's a billion direct mail mortgage pieces, whichever it is. It's a lot, Jeff, and we're excited to talk to you a little bit more on this next niche, which is reverse mortgage market. And talk a little bit about, Jeff, how some of your former FHA Streamline and conventional and even HARP marketers became fans of the reverse mortgage marketing niche.
Well, the reverse mortgage business in general has heated up over the last couple of years to the point where some of my clients are making 7, 8, 9, maybe even 11 points in rebate funding these loans. So if their average loan amount is $100,000 and they're making 9 points in rebate, it's a $9,000 revenue, and it's only costing them anywhere from about $1,000 to $2,000 in marketing to bring that loan in the door. So I've done millions of reverse mortgage mailers through the years. I've done direct mail for one reverse, American Advisors Group, and those two happen to be the top 2 companies in the United States right now. And I've done mail for both those clients in past years. And it seems like, some time went by and it kind of slowed down and it wasn't paying as much in rebates and they were hard loans to do. But right now, it just seems to be coming back strong, and some of my mortgage brokers and bankers that never did reverse mortgages are getting into it, saying, hey, Jeff, we're going to close 5 loans this month and we're going to make $100,000 in revenue on these loans. So it's going to be a big part of our business next year. And so we've kind of ramped up, and we've got a bunch of successful reverse mortgage mailers, letters, postcards. We've dialed in the data, the seniors with equity, and we're going to talk about that, but that's the basics on reverse.
Yeah, and that's a little different marketing niche, which requires a little different strategy and expertise. And that's one of the things that you bring to this, is that you bring your background of a vast amount of marketing expertise to the individual client and just add that to them as an added value. I've got another poll up right now. I'd like everybody to come back to their computers. If you've navigated away, go ahead and throw your vote up there. We'll close up that poll in about 10 seconds. But as we do that, Jeff, let's talk a little bit more about postcard marketing and seminar marketing for reverse mortgages versus using window envelopes and handwritten letters.
Well, I've talked to a lot of clients that have done direct mail for reverse mortgages, and what I hear and see out there is the average response rate on a reverse mortgage direct mail campaign right now is only about 20 to 30 incoming calls on 10,000 mailers. So they're down to getting 0.2 to 0.3% response on their direct mail. I just talked to a guy that mailed out 10,000 postcards, and I think he got 9 calls, so less than 0.1% response rate. So my experience is postcards just don't work very well in the mortgage industry. I don't know why. I can't really explain it. Yeah, you don't have to open them, so they're going to see it. But they see a postcard, and it kind of looks like the rest of the junk mail. Pretty pictures, color, thick. They're nice looking, but they just don't work. They don't generate phone calls. So most of the time I stay away from postcards for reverse mortgage, for any mortgage direct mail, quite honestly. You know, every once in a while a client will talk me into it, you know, but in general, you know, letters are you know, 0.3% response, 30 calls on 10,000, and postcards are 15. So it's just not worth doing, in my experience.
Great. Well, I'm going to show an example letter that you've used in a standard window envelope using a black and white laser letter. Point out the critical indicators of this particular campaign, Jeff, and why it worked.
Well, a letter's always more personal, even though they have to open it. The letter usually gets set aside with the rest of their bills, which all come in envelopes, and they get, you know, you might get 15 seconds of their time on a letter. You might only get 5 seconds of their time on a postcard. So this letter's designed very specific to, you know, invoking a response from a senior. So we put, you know, there's 1,757 people in Orange County, seniors that might qualify for this low, you know, fixed mortgage loan. This particular mail piece is geared towards showing a really low payment on a 30-year fixed rate loan and invoking a phone call from the senior. And then once you talk to the senior, you can decide whether it's best for them to get a 30-year fixed rate mortgage or open up the conversation about a reverse mortgage loan. So what I've learned is I can get twice as many phone calls by advertising a low payment 30-year fixed rate loan that we could sell to them. And it gives the mortgage company more opportunities to talk to more seniors and to get into the conversation about how a reverse mortgage loan could help them. You know, in this case, if you're a reverse mortgage company that only does reverse mortgages, this letter might not work for you. But if you do forward and reverse loans, you can get twice as many phone calls, twice as many opportunities, and sell more reverse mortgage loans by using this mail piece. We show them a really low payment. We talk about it's designed for seniors. We talk about, you know, maybe a reverse mortgage loan's right for you. Call us to discuss, and we've had some great response and conversion on that letter.
Well, Jeff, you've had a lot of clients that have utilized, you know, personal handwritten letters, but they've actually done them in their office in small quantities. Talk about some of the tests that you've done recently on marketing to seniors using actual handwritten letters, but doing them in larger quantity, like 3,000 and above.
Yeah, so a window envelope mailer is typically going to get, you know, 0.5% response if you do it with me, with my data and my letter. You're going to get 50 calls on 10,000. You know, they say 60% of window envelopes get opened and 40% go right to the trash can. So your 50 calls, you're really getting 50 calls out of the 6,000 people who opened your envelope. 4,000 people didn't even open it, threw right in the trash. So we've done some hand-addressed, handwritten addressed envelopes. This is not done on a computer font with, you know, some fancy Xerox laser. This is actually hand-addressed envelope, 46-cent first class stamp with no return address on it. So when these people get this envelope in the mail, you know, we estimate 99% of people are opening this envelope. They have to. It kind of looks like a wedding invitation. It's a little envelope. So we get a lot better open rate, so we get more response on this type of campaign. So for the seniors, the handwritten letters has been pretty successful. I've got a couple clients that do this every month, and, you know, they spend $4,000 a month, and they fund 4 reverse mortgage loans off these handwritten letters.
Now, you've used some letters that have been designed specifically to past prospect databases for large companies, as well as people that want to enter into the reverse mortgage market. Talk a little bit more about the different strategies you've used, Jeff, using letterhead versus the steno pad option.
So this client of mine that's up on the screen, they're in the top 20 of the largest reverse mortgage lenders in the country. I think they're funding 50 to 60 reverse mortgage loans a month. And what they did is they sent me a database of people that had called into their office about a reverse mortgage loan for the last 2 years, but didn't move forward and close. So they had like 3,000 people on that list that had called and never moved forward. So we sent a hand-addressed envelope with a handwritten letter. You know, dear John, you called before. Wanted to kind of update you about reverse mortgage loans. You know, the programs are changing. You know, call me. No pressure. You know, with a person's name on it, signed, and the disclosures on the back are just printed on the back of the letter. But, you know, we mailed 3,000 pieces, and instead of getting the average 0.5% response, which would be 15 phone calls, they took in 140 inbound phone calls. So we had, what is that, almost a 5% response, because we had a great list of prospects that were interested in reverse loans, and then a great letter, handwritten, hand addressed. So the combination of the list and the letter just got a huge response rate. 5% response on any direct mail is kind of unheard of, but this one really got it. I saw the call report. So that's, if you had a database of people you wanted to mail that were already kind of pre-qualified, maybe a bunch of internet leads you bought through the years, we could do these handwritten letters to a targeted list and get 5% response. Or the other letter that you're showing is a handwritten letter on a yellow legal pad where we handwrite the whole letter, put in their mortgage balance, put in the lender they're making their payments to, and we talk about, putting them in a reverse mortgage loan. My response rates on a non-prospect list, my cold list of just seniors with equity, has been anywhere from 1 to 3% response on these handwritten letters compared to, again, the 0.5% or 0.3% average in the nation. So I'm pretty excited about these letters. I've had a few guys do this, and then they're reordering every month and closing loans, so it's been successful.
Well, I've got a comparison here, Jeff, that just kind of talks through the different strategies that you've leveraged with reverse mortgage clients. Talk us through this, and then I'm going to go ahead and bring on our special reverse mortgage expert and have him talk a little bit more about getting these deals funded. Yeah,
so we did 10,000 letters for 59 cents a piece. You spend $5,900 on a 10,000 piece mailing. You get a 0.5% response, 50 calls, closed 3 loans. I put an average revenue in here of $12,000, which might be high for some customers, but I've got a guy in San Diego, California that funded 9 reverse mortgage loans last month for $180,000 in revenue. So he's making $20,000 a loan. Some people might only be making $4,000 or $5,000, but I put in 12. So you spend $5,900 and you make $36,000, 6-to-1 ROI. Then you come over to the handwritten letters, and instead of spending 59 cents a piece, this customer spent $1.85 a piece for 10,000 handwritten letters, but we got 260 phone calls and 16 closed loans. So it's a 10 times ROI, a lot more expensive letter, but a lot more effective. So,
well, before we bring in our next panelist, Jeff, I want you to just kind of talk about senior data and how you're able to target that senior that actually needs a reverse mortgage or is in the market for a reverse mortgage, rather than just blasting out every person that's over the age requirement.
Yeah, so here's an actual mailing list from a client that I did mail for in Wisconsin. It's a big reverse mortgage lender. We targeted seniors that were over 62 years old, and their spouse had to be over 62 years old. But we also targeted some specific data of how many years they had lived in that home. Obviously a lot of the seniors getting reverse mortgage loans have lived in the home 10, 15, 20 years or longer. We've got some different marketing for gender. We found that female singles are responding like 5 times as well to reverse mortgage offers than married couples where there is a, husband and wife. So we've got some little niches in this database where we can pull single female seniors with equity that are a lot more likely to respond to these offers. We have an average income for that particular, city or zip code. We know their LTV. We use some AVMs on our data, similar to what Zillow uses. They're not perfect, but they're within 10%, which is pretty good in this market. So we target the right LTVs, low LTVs, obviously. We don't like marketing seniors that have their homes paid for, because the chances of them getting a reverse mortgage is 10 times less than someone who's feeling the pain of making a mortgage payment every month. So on our reverse data, we target some real specific things: age, equity, male, female, gender, single, married, and we kind of combine all this for a good targeted list to get a good response and a good conversion to close loans.
And Jeff, you're doing more than just standard direct mail. You're also doing more of the relationship building marketing, like newsletters and things of that nature. I have one up on the screen. Walk us through how some
seniors don't make quick decisions. Okay, they tend to, they might call you and not do a loan for 3 months or 6 months and talk to the family members. And there's so much negative press out there about reverse mortgages that I designed this newsletter. The whole newsletter is based on stories from NRMLA's website about seniors that are very happy with their reverse mortgage. They got to stay in their home. They got to pay for in-home care. It's all positive stories about reverse mortgages. So I designed this newsletter all around that theory, and we'd mail to, seniors every month in your database and keep kind of drip marketing them with good news. And maybe eventually they read these stories and they identify with one of them. Oh, I used to be a teacher. I used to be in the military, and here's a success story. Someone really happy about getting a reverse mortgage. So this is kind of a longer-term marketing strategy where we mail newsletters every month with stories, and we change out the stories every month, all about reverse mortgages.
Great. Well, I'm going to go ahead and bring in our special guest panelist today. We're going to bring in John Betancourt from SunWest Mortgage in Southern California. John, are you there? John, is your phone off mute? Hopefully he'll plug in here in just a moment here, Jeff. But in terms of working with some of your reverse mortgage lenders, you've actually had a lot of people that were looking to get connected to a quality reverse mortgage lender. Talk a little bit more about what you've experienced in that marketplace and why you chose to bring in John as an expert in this particular field.
Well, I tend to get more involved with my clients instead of just sending out some, junk mail and making their phones ring. I mean, I like my clients to, convert loans and make money, so they'll come back and order more direct mail from me. I guess it's a, selfish thing that I want them to keep spending money with me. So I talk to a lot of my clients about, hey, where are you funding your reverse mortgage loans? Who's paying the best rebates? Who's got the quickest turn time? Who's really helping you? And, the name SunWest kept coming up with a lot of my clients, and it wasn't, a lender that I had heard about, all over the country, like a One Reverse that's on television all the time, or American Advisors Group. So basically I spoke to John and wanted to invite him on this phone call just to talk a little bit about, hey, how do we get these loans funded? What does this market look like right now? What separates, SunWest from all the other reverse mortgage wholesale lenders? I just keep hearing his name come up as a good lender that's been funding a lot of these loans for my clients and paying really good money and getting these things done quickly. So I wanted to get him on the call just to have someone they could call to maybe get signed up with to send their reverse mortgage loans to if they're just entering the business, or if they have a few lenders they're working with, maybe they want to add, SunWest to their stack, and they could do some things that maybe other people can't. And John's been in the business for a long time, so a lot of experience doing reverse mortgage loans. I think thousands of them through 10 or 15 years. So, anyways, I try to bring lenders to my clients to help them fund more loans. It's the basic idea.
Great. Well, and till John gets on the line, Jeff, talk a little bit more about how individuals can go about getting started with reverse mortgage marketing with you. I'm sorry, the question one more time, Dave? In terms of getting started with reverse mortgage marketing, for those that didn't sign on to the earlier session with the FHA Streamline, just walk them through what the next steps are if they want to get more information about reverse mortgage marketing.
Set aside 30 minutes for a conference call and call us and let me get on the phone and explain in great detail how we build the list. I'll pull the numbers for the state or states you're licensed in. We'll take a look at how many seniors with equity are out there on our list. I'll show you 3 or 4 successful letters and walk you through, hey, here's the right list, here's the right letter. Let's test this thing out and see if we can make your phones ring and bring you a few more loans in the door.
Okay. Well, in terms of John's not able to get on for some reason. He's having technical difficulties. But for those of you that are on the webinar, we'll go ahead and send out a link for more information to talk to John from SunWest Mortgage. We're going to transition now to how to recruit loan officers who can close loans. So if you're got another extra 20 minutes and you want to bring on a team or grow your current team of loan officers who are taking incoming calls, this is your opportunity to learn from, an expert that's actually been there, done that, and helped a lot of other mortgage companies to hire the very best closers out there. Jeff, talk a little bit more about your expertise in this particular area.
Well, being that I've done all this direct mail in the mortgage industry for 20 years, and I own my own mortgage company, and I used to spend $200,000 a month on direct mail. I mean, I've learned a lot of things about making the phones ring, but even more important is closing the loans. And what used to frustrate me at my mortgage company was I would send 100 phone calls to a loan officer that I had named Ron. And Ron, at the end of the month, would close 20 loans at $5,000 average revenue loan. So I'd make $100,000 off, $10,000 worth of phone calls that I sent Ron. And then I'd have another loan officer sitting right next to him taking the same phone calls, 100 inbound phone calls, and Carrie would close 2 loans. And I would make $10,000, and I spent $10,000, and I lost money on Carrie, and I was making a fortune on Ron. So I started looking at, my average closing ratio for my office was around 10%. Actually, it wasn't quite that good. I'd like to say 10%. It was probably more like 7%. And I had a few guys and gals closing at 20 and a few closing at 2. And I was always trying to improve that. In fact, one year I took a look at something. I said, if I can move my average closing ratio on my calls from 7% to 8%, if I can just move the needle 1% on my closing ratio, I personally would have made an additional $1 million in income that year by moving my closing ratio by 1%. So I started doing all kinds of work on personality profiling, and I worked with a business consultant. His name's James Karasek. I might get him on this call later. But James and I started putting together these mortgage personality profiles where we could start to identify, hey, here's the personality that can take an incoming call over the telephone, build rapport, warm up to them, and close the lead. So we kind of started identifying certain personality types that were really good taking incoming calls and closing them, and we'd identify the ones that were not. So we built this whole hiring system that really made me a lot of money in my mortgage company. And I don't know, I kind of forgot about it since I closed my company down. We've never brought this up before, but I started talking to some of my mortgage clients, and they're having the same challenges where, one guy just got 100 phone calls on his FHA campaign and closed 7 loans, and another guy closed, 27 loans. And what's the difference? Well, the difference is the loan officer taking the call. Some of it's, we've got places that do FHA loans below 640 FICO, so the product is important. And one guy's a banker, one guy's a broker, one's closing loans in 3 weeks, and one's closing loans in 3 months. So product does have something to do with your closing ratio, but the most important thing, that I found is the types of loan officers you're hiring. So I wanted to go through some information about things that I spent hundreds of hours working on, and maybe I can share with some clients to up their closing ratio and hire better loan officers. So,
well, right now I've got a poll up, and I just want to get that out there for anybody that has just been on for the marketing aspects. If you'd like to be contacted by one of Jeff's marketing representatives, go ahead and cast your vote now on when you'd like to be contacted so that they can get to the people that are the most interested right away. And if you're not interested, we're not going to bother you with this follow-up opportunity, but go ahead and cast your vote, and I'll close that poll in about 10 seconds. While I'm doing that, Jeff, I want you to give the audience that stuck around or is signed on for this particular session, you've been a master interviewer over the years of bringing on top-quality closers. What are maybe, 1 or 2 of your best interview questions that really help you define, without even taking the personality assessment, what are a couple of critical indicator questions that you ask during an interview to know whether or not you got, a closer or you got a deadbeat that's just not going to be a final contestant on the opportunities that you bring into your office?
Well, I'll give you one that I think is super important. I mean, your biggest competition on trying to get a refinance borrower to close their loan with you is going to be their originating lender. I mean, everybody knows they can call their lender back and refinance their loan, and typically they'll do it for less fees, and probably a pretty aggressive rate. So that's our biggest competition out there, is them calling their lender back and trying to refinance their loan there for a lower amount. So one of the questions I'd ask in the interview would be, playing like I'm the borrower, why would I want to do my loan with, direct funding? Your interest rate's high and your fees are, $3,500 when I can go back to my lender and get, the same interest rate with no fees, or a streamline refinance. That would be the number one question I'd ask them, to see if they can overcome the objection of your rate is high and your fees are high. And I would see how that loan officer answered that question. Some of them, would have no answer for it, and some of them would come back with great information about comparing, actual good faith estimates and, looking at the lifetime of the loan. I mean, I just see how they answered that basic objection, because that is something that's going to come up on the phone. And let me say something, Dave, about that. There's two loan officers in the world. Okay, there's your self-gen loan officers that are out calling on realtors trying to get purchase loans. And typically they're pretty good salespeople in person. They typically know how to do loans very well. They have maybe some processing background. They understand, debt-to-income ratio and how to run DU and manipulate DU, and they're really good at that. And those loan officers that work by referral, if the real estate agent says, hey, buyer, here's my loan officer. He's great. He'll take good care of you. We want to get your deal closed and get you in your new home. Let me introduce you to John. Well, the loan officer, John, has already been referred with high accolades about how great he is, so he really doesn't have to build any trust with that borrower. He just has to do a good job, take their application, quote a rate, fees, and he can get that loan. The other loan officer is the marketing lead loan officer, who has to take an incoming call or an internet lead and warm up to that borrower, build rapport, ask a lot of information, do the discovery on the borrower, and then quote, rates and fees and try to close the loan. My experience is those are two totally different people, and sometimes the marketing loan officer that's taking all these inbound phone calls, he has a huge closing ratio on leads, but he can't go talk to a realtor and get their business. He's not, or she's not real good at that. And vice versa, the loan officer that's phenomenal doing loans, they might be doing 15 loans a month, all purchase business, all referral. You put them on an incoming phone call where the question comes in, what's your rate? And they choke. They don't know how to convert those calls, build rapport, and close to get that into a closed loan. So, there's some loan officers out there that are really good hybrids that can do both sides of it, but my experience is you're usually good at one or the other, and you need training on both sides of it to be good at both sides of it.
That's great. Well, you've put together a couple of things in here in terms of how to increase performance of your team. You said that you give access to the participants on the webinar to this assessment tool that you've been building, and to get a hold of that information, Jeff, or they just need to call your office?
Yeah, I can provide, copies of this information if they want to, take a look closer. We've got some more information to send about our little hiring package and our mortgage personality profiling. James Karasek, one of my sales managers in here, is kind of leading up that division of our company, so they'll be talking to him, and he can send some more information to him.
Well, let's just get into these specific tips and maybe give a little bit of an overview of what you've come up with in terms of closing ratios on leads, using direct mail, and just some benchmark factors that managers and broker owners should be aware of.
Yeah, so the average closing ratio on leads is 6%. If you want to look at internet leads, SEO, telemarketing, TV and radio, and direct mail. Direct mail has always been known as the highest closing ratio because these people are calling you. They got a letter in the mail, they read it, they're interested, they're calling you. So the average closing ratio in direct mail is typically higher than everything else, but the cost per call is also higher. So it's important to treat those leads with, the time and energy that they demanded to get them to close. So I've got here up on the screen, mailing 10,000 letters, getting 100 phone calls. Obviously, closing is 6% versus 12%. What does that mean to you in profitability? And it's a huge number. An extra $30,000 in profit if you can double your closing ratio by hiring the right loan officers and getting them trained and doing the right letters and direct mail. But so we can help improve their closing ratio by just hiring better loan officers with a personality that can close leads.
You also just talk about a simple thing that people can do a better job of is just answering calls. But you've also got some strategies on how to improve upon that with some technology as well. But I know there's a lot of content on this particular slide, Jeff, but talk about how you've been able to improve the call response or the call answering in your
Well, we have toll-free tracking numbers that record all the phone calls and send you an email every time you get a call. So if you do miss a call, because it's common, you've got all your loan officers on the phone and a call comes in and they go to voicemail and sometimes they don't leave a message. So we've got, call tracking software we can offer that'll email them every time they get a call with a copy of the call recording. You can hear how your loan officers are doing on the phone call, pick up their caller ID, call them back. You'd be surprised how many of my clients miss 20% of their phone calls. They don't even answer them. And, 20 missed calls at a 10% closing ratio, you missed 2 loans for $10,000 in revenue. I mean, that'll pay for your whole mail campaign. So we spend a lot of time training our clients on how to set up their phone system to answer all the calls. Don't miss calls. That's important.
And this is an example of one of the printouts that comes with your call tracking service where they can actually go in there and listen to the call recording and see the caller ID and then use it for training purposes, which is one of the things that you said is the best thing about call recording. It's not to police the loan officers, but more to train them from their mistakes and missed opportunities.
Yeah, so this list just shows every phone call you got, what day and time it came in, the caller ID, the person. Some of them have names and addresses of the person who called, how long the call was, and it's a good report to look at to make sure you're managing these leads. I mean, if you're going to spend money on leads, there is an aspect of time invested in making sure these leads close, whether it's listening to phone calls, watching the calls, coaching the loan officers. I mean, it's not something that just, you send the mailer out and you make $50,000 on a $5,000 mailer. I mean, there's some effort that needs to go in to properly manage all these leads and calls and loan officers. But I can give some people some shortcuts on the most important things that I worked on through the years. So,
well, you've also just talked about, or you've shared a very sensitive issue, which is taking leads away and kind of recycling those leads or putting an expiration on leads. Talk a little bit more about how you've done that with top salespeople. After you've given them, a good dosage of leads and they're not closing them because they've gotten a little bit comfortable or lazy. How have you, taken that and not, ticked off your top sales professionals?
Well, I think just putting an expiration date on the leads is important. Don't let these loan officers think that, they took 100 inbound phone calls and they only closed 5 loans. I guarantee there's another 10 to 15 loans sitting in those leads, and if they're not following up with them and you don't see movement and engagement in phone conversations and emails, I let the loan officer know, hey, you've got this lead for 7 days. If you don't, pull credit and get a commitment, we're going to take this lead away from you and give it to someone else to work. And any good salesperson hates for a lead to be taken away and then closed by another loan officer, so it tends to put a lot more motivation to make sure they're on top of these leads. They're calling them, they're emailing them. They're not just leaving one voicemail and then, walking away from this $100 phone call that came in. So putting an expiration date on leads, it can be a great way to improve your closing ratio.
I also love your third strategy here, which is kind of like what we call the biggest loser strategy. And if you're below the line, you're on the bubble, and you do have to have that, that watermark just so people know when they're below the line and when they're on the cut mark. So talk a little bit more about how you've done that, and how much grace do you give somebody when they, or maybe getting off to a slow start, or going through a life challenge that's causing them to be less productive at work.
Yeah, that could be a whole hour-long conversation about that. But in general, it's just important to, before you hire these people to take your expensive leads and you're going to make this big investment, let's run this DISC mortgage personality profile on these loan officers and make sure that they've got the personality type that can build rapport and close over the telephone. Because if they can't, I don't want you to ever hire Lisa and Jack on this list that are closing 1 or 3 loans out of 100 inbound phone calls. Get rid of those low profitability loan officers that can't close. I mean, that's really what it comes down to. I can go into this in more detail at a later time, but it's pretty obvious. You want to keep your best closers, and some of the best mortgage companies out there that work leads have the leads first delivered to the top closers, and then, the overflow calls go to the lower percentage rate closers. So it kind of encourages, these loan officers to work these leads and close them.
Great. So as we wrap up here, Jeff, talk about these last couple strategies in terms of the letter from the president and how you've been able to pull that off, and then just, the idea about scheduling follow-up phone calls and how profitable that's been for you.
Yeah, it's funny, back when I used to mail this letter, President Bush was in office, and they used to laugh when they got the letter. Oh, President Bush is mailing me a letter. Or is there really a Jeff Bush at this company, and are you really the president? It was kind of funny. But I used to mail this letter out to every person who called our office, because what I found is a lot of borrowers that called our office and gave us their Social Security number so we could run their credit never heard from us again. And it was really discouraging to find that out. So I used to mail this letter, and I would track how many phone calls I got back from borrowers saying, hey, no one ever got back to me. And then I would pin those calls on whichever loan officer it was. And, a lot of times it was like one loan officer that was just being kind of lazy, not calling people back, or, maybe they ran their credit and they didn't qualify, so they just decided not to call the person back. But, we had rules that we always had to follow up with the customer in some fashion and let them know, why they were getting the loan or not getting the loan. So the letter from the president just worked really well for me to kind of get a pulse on, make sure we were on top of these leads.
And then just phone calls, Jeff, is there anything specific about these 2-week follow-up phone calls that you found to be profitable?
Well, a lot of times the incoming call comes in and the person gets rates and fees, and then they go back and shop it through their bank and try to see if they can get a better loan. It just happens, just the other day to one of my clients where, the prospect goes back to their lender, thinks they're going to get a better deal, and then, 60 days later the lender still hasn't moved their loan forward at all because they're so busy or the rates went up. So it just always helps to call back through your leads. 2 weeks later, 30 days later, 60 days later, there's always people that change their mind and might decide to move forward with you. So just putting those calls out there and make sure that it's not, we didn't close them on the first call, so we're just going to forget about them. Keep them in your database and keep calling them.
Great. And then I'm going to throw up one last poll for those of you that are still on the line with us as we wrap up here. Please go ahead and cast your response to this. We're just kind of curious of how many loan officers that you have inside of your office or offices. And the last two little tips, Jeff, were number one, listening to phone calls and doing sales training with your staff, and then having a rework team. Would you talk through those specific strategies?
So the rework team, I had at my office, we had 25 loan officers, and I think I had 2 people on the rework team. And after the loan officers had gone through the lead and said that there's nothing there, these people aren't getting a loan, I would typically give all those leads to 2 people and have them start calling and staying in touch with these people. And it was, magic. Every month I would get, 8 or 9 extra funded loans out of all these leads that the rest of the loan officers said were dead. And I was actually paying the rework team a little bit higher commission because they were having to make all outbound calls, not getting any incoming direct mail calls. And it was amazing. Every month I would get 8 or 9 funded loans for free, marketing I already spent money on, just from a loan officer calling back, and they would say something like they were the manager and saw that you'd called a month ago and never moved forward with the loan. What happened? And a lot of times it was, I didn't like the loan officer I talked to, or they didn't call me back, or it was amazing. The rework team is always, important to have it inside if you're buying a lot of leads.
Great. Well, if everybody can go ahead and cast their vote, we're going to go ahead and close up that poll and wrap up the presentation. But, Jeff, any final words in terms of the marketing strategies we've discussed or the recruiting strategies that you've just shared with us?
Yeah, this is the most important thing of hiring loan officers that can close leads as far as I'm concerned, as far as my offer to you. I am so confident that my DISC personality profile that has a lot of mortgage information built into it is accurate, that I think I can predict the best loan officers in your office for closing leads without knowing them, without ever talking to them, without you telling me anything. So this is the offer that I want to make. Is I want you to call us and sign up to run this mortgage DISC personality profile for a group of your loan officers. I don't care if it's 3 people or 5 or 20. If they fill out this personality profile, I will be able to guess who your best closers are without even knowing them, just from this personality profile. So if I can do that, if I can accurately pick out, hey, you've got 10 loan officers that took my personality profile test, here's your top 3 closers. If this test is that accurate, then you should be using it as a screening tool moving forward, and don't hire any loan officers to work leads unless their personality, it's not really a test, it's more of a personality profile, I think, to make it all legal. I will be able to identify who can build rapport and who can close just from running them through this personality profile. And I got to the point where I really stopped doing second interviews. If they made it through my personality profile and then I met with them in one interview, you know, I would hire them, and that thing was way more accurate than whatever interview questions I could ask her, because everyone's a salesperson in the interview, right? So my offer is to have some of these mortgage companies that are on the phone with us have me personality profile their sales team and see if I can pick out who the best closers are just from the results of the personality profile. And if it's that accurate, you know, I would not hire anyone without using this thing. I mean, it got to the point, like I said, it was more accurate than what I could pick out of them on an interview. So I'd love to talk to some guys about hiring loan officers that can close leads. And again, James Karasek, my sales manager, is going to go through in more detail. You know, it costs anywhere from $50 to $100. I think I ran out of time on a lot of the slides I wanted to go through on this. But again, if they want more information on hiring loan officers, email me, and James or myself will follow up and give them more details on this.
Great. Well, for everybody that's still on the phone or on the webinar, 888-212-4343. That's the number to call. Or you can email Jeff directly at jeffbush@overflowworks.com. Jeff, we thank you so much for your exciting interview, and this is great information for anybody that wants to grow and scale their mortgage business. And if you're looking to increase your marketing response rates and grow your practice and business, please be sure to call Jeff at 888-212-4343. Have a great afternoon, everybody.